Finally, let's continue the measurement and recording depreciation on PP&E by double decline balance method. It can be used to write off to allocate a large amount of cost near the beginning of the asset useful life. If we purchase that asset and then we are going to use this asset first year to make huge revenue, okay, and then you can use this double declining the balance method in any kind of asset. Okay, so double declining means we make double in this asset allocation in the first year and the second year as well as the same. So we use the book value of the previous year, that is the depreciable cost. That means that we do not subtract the residual value into the depreciable cost. So we just directly depreciate the book value of the previous year times 2 divided by useful life. So 2 means the double declining. We can use just 1.5 times declining method based on the year of the revenue projections that we are making profit revenue the first year a lot. That means that we are using this asset first year a lot. Okay, so it can be used to reduce the tax payment earlier, because we can recognize the depreciation expense a lot in the first year. That means that we don't have to pay a lot in the tax amount by reducing income before tax. Okay, so let's go to this exercise, which is the same exercise as the previous cases. So double decline depreciation expense, we starting from the book value. Always book value is the beginning balance or the purchase price. And then how do you calculate it? Right, the book value of the previous year or the beginning of this book value. So this book value divided times 2 divided by 5 times 2 divided by 5. So we got 12,400. So it's not 5 years, 3 years. So 20,667. Oh, that's a lot comparing this depreciation of unit of production method or $10,000 depreciation expense. So we want to depreciate a lot. Okay, first year the depreciation expense is same as the accumulated depreciation on the table. And then the book value is decreased by the accumulated depreciation. And then second year depreciation expense by this double declining balance is using this previous year book value times 2 divided by year 3. So 6,889 is the second year depreciation expense, should be added into the accumulated depreciation on the balance sheet. So we increase this accumulated depreciation, and then this amount is also the book value minus accumulated depreciation is net book value of the second year. And then the last year is the process is a little bit different. We put $1,000 first because we have the estimated residual value $1,000. In order to make this $1,000 as this estimated the residual value from the book value to 3,444, then how do you get this depreciation expense? That's correct. That is the 3,444 minus 1,000 last year, so that we can get the right amount of depreciation expense that should be added into the accumulated depreciation, right? So it should be now how much? We can estimate, right? $30,000, so that we remain this $1,000 for the residual value. Let's generalize this transaction, this adjustment transaction, based on the schedule. So we have the same same name of account, I'm gonna use this. So I just want to change the color. Okay, we purchase like this. Then depreciation expense first year. Again, this accumulate depreciation is journal entry, not the value of the balance sheet. Okay, that means that the each year amount of this journal entry is just for that year amount of journal entry, just one transaction. But this accumulate depreciation amount is the balance sheet balance, accumulated balance. Okay, that's why it should be different. Okay, so let's record again. The truck starting from $31,000, and then accumulate depreciation $20,667, and then the truck net book value by the double decline. Oh, we depreciate a lot for the first year, so the truck net book balance is only $10,000 because we depreciate a lot for the first year, right? Here we depreciated this 20,667. So as you can see that for the first year, the income before tax we reduced by 20,667. So that if we have other the sales or other revenue, then we can reduce the income before tax a lot, right? Income before tax a lot. That's the point of this transaction. Okay, and then retain the earning. Now, oops. Oh, we need to subtract the cash amount, $31,000 payout. Then second year, again, the second year, the beginning balance is the same as the ending balance of the last year. So we started from then on. Okay, and then let's record this depreciation expense. The second year, how much? Right, 6,889. But from the second year, the depreciation expense is not much. So that means we pay tax more amount from the next year, because we recognize the depreciation expense that reduced the income before tax a lot for the first year. So the net income should be added into the next year. Then we need to add this accumulated depreciation, which is contra account that reduced the truck $31,000 original cost. Now we got in the truck net book value 3,444. Okay. Then the last year, again the cash balance. We started from the ending balance of the last year as the beginning balance of the current year that we want to start it, that we want to get started. Okay, then depreciation expense, the third year, 2,444, the income before tax, then net income. So as time goes by, the tax reduction effect, it gets lower, right? Because we reduce the tax amount the first year a lot by recognizing more expenses for the first year. Then we added this net income. So almost done. 2,444. So we now got the truck net book value $1,000. It's the same as residual value $1,000. This is how to record this depreciation expense and accumulate depreciation by the double declining balance method. Then finally, let's compare this the expenses, depreciation expenses for the step line equally distributed, and then the cost $30,000 distributed. the unit of production was based on the actual use of this asset, right? Actual use of this asset, but the total sum of this depreciation expense is the cost of this asset, except for this the residual value $1,000, so $30,000, which is the same as under this straight line method. Double decline balance method, the sum of this depreciation expense for every year is the same, $30,000, but the point is the double decline balance, we want to allocate the cost for the first year a lot. By doing so, we could reduce the tax amount, okay? But the last year, we recognize very small amount of depreciation expense. That means that we pay tax more. We have to pay tax more. But nobody wants to pay tax a lot the first year. So if we choose double declining balance for the balance sheet of financial reporting, that means that you want to reduce the tax payment for the first year, right? Yeah, that's it. See you in the next video clip, guys. Bye-bye.